Hi, this is Skyler Weinand with Regan Capital. We're pleased to present part one in a series that talks about positioning a portfolio for potentially higher interest rates and a steepening of the yield curve. These broad-based indices, we drop in yield, duration, and we look at what happens if interest rates rise only 55 basis points. The 10-year right now is at 0.95. If the 10-year ends next year at 150, here's the losses that you could expect owning just the broad-based indices of these sectors. Treasuries have a 7-year duration. If you're in mortgages or you're in high yield, you have a much lower duration. You're going to lose a lot less money if interest rates rise. And you can see here the one winner in this is high yield, because you have this coupon that actually makes up for rising interest rates. And this is really a unique environment because yields are so low that just a 50 basis point or a half a point rise in interest rates from where we are entails a tremendous amount of downside for traditional fixed income investments. Okay, what could make the 10-year rise? We don't know, but from what we've seen, it's not just an inflation story anymore. Historically, the Fed anchors the front end of the curve, and inflation anchors the back end of the curve. The only reason the back end of the curve would steepen out or 10 years would rise is that, inflation is expected to be higher. Well, I think a lot of that's changed. Inflation's been so low for so long, and there are other forces at play that we want to highlight here and that the market is paying attention to. So this chart here shows the 10-year note currently at 0.94%. It shows the Treasury inflation protected note, the 10-year tip, at negative 1.1%. So if you want to protect against inflation right now and you want to own that 10-year bond, you're investing at a negative 1.1% yield, okay? The spread between those is about 2.04%. So that is what the market is pricing in for inflation, over 2% right now. The Fed balance sheet has almost doubled in the last 16 months. So September of 2019, the Fed balance sheet was 3.75 trillion. Now it's 7.4 trillion. And what effect has that really had? So you had this huge drop. Obviously, the Fed dropped interest rates by 150 basis points in March, and you had this huge infusion of cash. Okay, so that's what you saw here, the difference between the 10-year going from almost 2 to, I think it troughed at 0.35, Fed balance sheet getting up above 7 trillion. But ironically, since the middle of the summer, 10 years have gone up as Fed balance sheet has also gone up. So it's contrary to what we would think, that if Fed balance sheet is going up, perhaps they're controlling interest rates and they can keep rates down. They haven't done that yet. They haven't said, we're going to keep 10 years down, because what they've done is basically, they've done their effect. They've done what they wanted to do. But now the market takes control and says, well, we could have inflation. We could have a supply and demand issue where foreign investors just don't want to buy 10 years anymore. The dollar right now is as low as it's been in the last 5 years, which makes our treasuries, our interest rates, a lot less attractive for foreign investors. 4 periods, the last 4 times we've had recovery, 84, 94, 04, and 2010, this chart here shows year over year pops in the 10-year. And you can see here some serious pops. And this line right here is over a 1% pop. And we're only talking about a 50 basis point pop potentially over the next 12 to 18 months. So you can see here that interest rates can change much quicker than anyone could expect. And with the Fed having spent as much money as they have already and not being able to control the long end from getting higher, they would have to spend multiples more in future stimulus in order to keep rates down. And how does that affect us? What does that affect? It primarily affects prepayments. And so if rates are low, obviously people refinance their mortgage and lock in lower interest rates and lower payments. What this chart shows is that 97% of all mortgage borrowers right now are in the money. And that's everything to the right side of this line. So down here, you have this cohort that's 0 to 25 basis points in the money. If the mortgage rate right now is 2.625, around 2 5/8, those are borrowers that really have under a 3% current mortgage. This is 3 1/4 mortgage. This is 350 mortgage. If you have a 350 or higher mortgage rate right now, I would suggest you refinancing. And that's what these folks are doing. And over here to the right, you have CPR. So this is 25% of these borrowers in this cohort are prepaying on a monthly basis. And it's really elevated over here with these borrowers that are, paying a 4 to 4.5% coupon. But you can see here, there's this huge shift just between paying 350 and maybe 3.25, where those borrowers just aren't as incentivized to, lock in lower rates and pay the $6,000 refinance fee. So this is kind of what we're playing on when we talk about in the next couple of slides, looking at some interest-only strips that can really pop with a potential rise in interest rates. So our goals, the way we're trying to position ourselves is really not to take a bias on interest rates, but have asymmetric upside to rates rising. Because the market right now, how much low we saw at the depths in March, the 10-year got to about 0.35. Now we're at 0.95. I could easily see it going to 150 or 2 over the next 3 to 4 years. Our point being is that there's asymmetry where rates can only get so low, but rates can go much, much higher than where they are now over the next, call it 5 years. So we're trying to take positions across our book, primarily in non-agency securities, to rising rates, faster prepayments, and deals getting called. And we saw that faster prepayments portion on the last slide. And faster prepayments can come not only from lower interest rates, but also from stronger housing. And I didn't hit those charts here, but we've hit those charts repeatedly of how well housing is doing. Our goal is also to actively trade bonds that are in high demand, the bonds that we'll go over here in a second. Sell positions, we sold about 5 million this morning, and positions that have really appreciated up to par that have really no juice left in them. And example bonds that we'll go over here are these new issue agency only bonds, as well as some seasoned deep discount non-agency bonds where we'll do an actual screen share, which will be cool. Okay, so the first one.